Hello, my friend. Welcome to Charlie Retail Invest. Let's track the latest trend in US economy and share our in-depth analysis and recent investment in stocks and bonds. As we can see, bonds, especially long-term treasury bonds, have been tanking in price for the past 6 weeks. If you look at the price chart of TLT, the 20+ years treasury bond ETF, we can see that TLT's price has been dropping from $101 per share back on September 16th, all the way to a low of $91.2 on October 29th, with a decrease of over 10% in a month and a half. Many bond investors are now worried that interest rate will keep going up because of sticky inflation and crazy deficit spending from the US government, and the 10-year yield will rise above 5% in the coming year. Recently, there have been several Wall Street investors, including Stanley Druckenmiller and Paul Tudor Jones, that went public to be bearish on US Treasury bonds, claiming that the 10-year yield should be way above 5%, given the projected high inflation and heavy government debt. If their claims were true, TLT price will decrease by another 10%, because the 10-year yield right now is around 4.3%. Their talks have impacted a lot of retail investors over the outlook of the bond market. However, we need to be extremely cautious on their public remarks about the future of bonds. This is because even though they were shorting bonds in the beginning of September, that doesn't mean they are still keeping those short positions by now, the end of October. It's highly likely that these financial tycoons have already made huge profits from the oversold flow of bonds in the past 6 weeks, and that they had cleared out their short positions and secured short-term profits. As a matter of fact, they might be switching to long positions for bonds right now and are selling stocks at hefty prices instead to make more money. It's very common for these high-profile investors to use the media as a tool to scare people to sell bonds at a loss, and then they can maximize their profits and take advantage of retail investors like ourselves. We really need to be extra careful before we sell our positions at a loss, not to be manipulated by the media or the Wall Street so easily. On the contrary to what bond bears are claiming, the most recent PCE data reviewed by the US Bureau of Financial Analysis has shown that PCE in Q3 of 2024 is just at 2.2%. PCE is a key indicator of inflation that is being considered by the Federal Reserve when making decisions on benchmark interest rate. And the PCE number is significantly lower than Q2 of 2024, which was at 2.8% back then, and now is way lower than the 5% or above value in 2022 and 2023. In addition, the current PCE level is similar to that in the beginning of 2018, which means that inflation is indeed under control, and we might not see it come back in the coming months. We also need to keep in mind that inflation coming under 2% doesn't mean that the prices of goods and services go down. That would require PCE and CPI to go below zero, but it means that the acceleration rate of prices has come down from 5% to 3% or lower. And we know that medium to long-term US Treasury bond yield is determined by inflation rate or CPI in the US. If inflation rate is kept at 3% or below, the 10-year yield will gradually come down from 4.3% right now to 4% or 3.9%, and TLT's price will go up from $92 per share to $96 or even higher in the coming weeks. At the same time, in order to stabilize the interest rate from going up quickly, the US Department of Treasury has announced its plan recently to cut the amount of bonds that it will issue in December of 2024. And this action will help boosting up the bond price and make the bond yield go lower from the current level. So as of early October to early November in 2024, we see that stocks, gold, and Bitcoin prices are all at or near all-time high positions, and it's actually a great opportunity to buy some bonds cheaply, given that long bonds have at least 5% upside in price growth, plus 4% annual yield. That would give you at least 10% annual return for next year, which is quite impressive considering the low risk of investing in treasury bonds compared to stocks. Unless inflation comes back and the Federal Reserve has to increase benchmark interest rate again to control inflation, we will likely see the bond price to go up in the next 3 months. Our investment portfolio has held more than 70% of our positions in medium to long bonds. Now let's talk about the stock market. On October 30th, Supermicro Computer's stock price dropped by over 28% in a single day. This is because its auditor, Ernst & Young, has resigned last week after raising significant concerns about the company's internal records, board independence, and accounting practices. In other words, it's more than likely that Supermicro Computer has been cooking their financial report books, and their reports on revenues and earnings may just be fake numbers. And actually, this is not the first time that Supermicro Computer had been involved in investigation on fraudulent financial reporting. Back in 2020, the company had been investigated by the SEC on improperly accounting for $200 million in expenses and sales. Some traders might think it's a good time to buy SMCI after its stock crashed and make quick profit, but I would recommend not touching this stock because it's likely that the stock price will keep falling down until it closes its door or get acquired by another company at a much cheaper price. So why catching a falling knife when there are so many other great companies out there to invest? Supermicro has lost its credibility and the market will dump it like trash. As we move past the Q3 earnings season, it's clear that the stock market has been pretty sluggish after its bullish rally from early September till mid-October. As of October 31st, even the 3 major indexes, the SP 500, Nasdaq 100, and Dow Jones Industrial, has all been falling down, marking an end to the bullish rally pre-election. Many companies' financial reports are actually not bad, but their stocks tank after the earnings just because their forward guidance earnings do not meet Wall Street's expectations. It's very common to see a company stock tank by 5 or 10% in a single day, even for big corporations like Eli Lilly. As the largest pharmaceutical company in the world, Lilly's stock price dropped by over 6% in a single day after it announced that its Q3 revenue is at $11.4 billion, slightly lower than expectation of $12.1 billion set by analysts. Taiwan Semiconductor Corporation's price dropped by over 9% earlier this week as well, and AMD's stock price tanked by a whopping 10.6% after its Q3 earnings released on October 29th. As a matter of fact, semiconductor industry had been selling rapidly by the market for the past few days, which might be actually a good entry point for investors to buy some semiconductor ETF like SOXX at a cheaper price than September. However, we can see the market sentiment has gradually shifted from being super bullish on the future performance of stocks to being a bit defensive and trying to go risk off, at least until November 5th, when the presidential election is over. If a company's earnings miss the expectation, it's likely that its stock gets dumped by the market quickly. If we look at the difference between the percentage of stocks that are at 1-year high versus the percentage of stocks at 1-year low, we can see the differential has been declining since October 10th and is down from 8.4% in early October to 4.7% in late October, which means that more and more stocks are at their 1-year lows right now. And if you look at the number of stocks that are in rising pattern versus stocks that are in declining pattern, we can see the same trend where more stocks are actually falling in price versus stocks that are rising. This means that most stocks have been tumbling for at least 2 weeks. Even for Magnificent 7, we can see giants like Microsoft and Meta stocks tanking by 3% or 5% in a single day after their financial reports were published. More investors are selling right now to take profits off the table and wait for the presidential election to settle down before they decide whether to come back into the stock market or hold even longer. So essentially, the stock market correction has already started by the end of October. We might not see a huge decline in stock index like what we saw back in early August of this year, when the Japanese yen carry trade led to a 15% decrease of Nasdaq 100 index in 3 weeks. However, we do believe it's a decent opportunity to buy the dip into stock index ETF such as QQQ and VOO at a 3% or 5% discounted price compared to their peak value. The big crash of the stock market may not happen just yet because the consumer index, liquidity, retail sales numbers, and job numbers are not that bad yet. We could see a huge downturn in stock market in the second half of 2025, so we need to be prepared mentally. Nonetheless, we are still in early November, so we anticipate the stock market to rally back shortly after the presidential election on November 5th, and the year end of 2024 would be a good time for the stock market. This is CRI Investment Portfolio as of October 31st. The most heavily investment is still TMF, which is 3 times leveraged to 20 plus years US Treasury bond, and it takes 52% of the entire position. We are bullish on the performance of the long bonds over the next 2 to 3 months, and we'll hold TMF position until it reaches above $56 per share or higher. The second largest investment is Lockheed Martin, or LMT, and as detailed in previous videos, we've been purchasing LMT ever since the stock price crashed after its Q3 earnings back in mid-October. Now LMT takes up 11% of our portfolio with an average purchase price of $564 per share. The third place goes for UST, which is an ETF that's 2 times leveraged to 7 to 10 years Treasury bond with a weighting of 8.4%. We anticipate the 10-year yield to go down from 4.3% to 3.8% in the coming months, and we'll consider selling UST after the 10-year yield goes below 3.9%. The next investment is Occidental Petroleum Company, or Oxy. We know that crude oil price has been dropping heavily after Israel and Iran's conflicts were better controlled, and Oxy's stock price has reached to a 1-year bottom. We're confident that energy stocks will do much better in the first half of 2025, and we'll hold Oxy until the oil price comes back to a much higher position next year before selling them for profit. The low oil price right now also reveals the fact that our economy is not as strong as the media reports because the manufacturing sector has been in recession for the past 2 years, and oil consumption and the need for oil are still very low right now, which only happens when we are in recession territory. UBT is our 5th largest investment, and it's 2 times leveraged to 20 plus year Treasury bond. Google stock comes next with a 4.6% weighting of the portfolio, and we bought Google before its Q3 earnings, and we'll hold its stock for long-term investment because of its relatively low PE ratio, robust business, and potential growth in AI. We actually bought a bit more semiconductor ETF, SOXX, on October 31st, and SOXX is now our 7th largest holding, with a unit cost of $226 per share. We will hold SOXX as long-term investment as well, because the need for chips will continue, although individual chip makers like NVIDIA and AMD are really high in terms of valuation right now. The 8th holding is Hong Kong Stock Index ETF, EWH. As we discussed before, we are still waiting for the Central Bank of China to release more stimulus package after the presidential election on November 5th, and we'll sell EWH for short-term profit if we see a second peak in Hong Kong and China's stock market in mid-November or December of 2024. Overall, you can see that we have Treasury bond ETFs as the predominant investment that takes over 70% of our entire portfolio. After bond prices come back down to a high level, we will sell some of the bonds for profits and use the cash to buy stocks, such that the rebalancing between stocks and bonds can be achieved. If in the near future the market has any turbulence or headwinds, we will keep updating our investment strategy with you as soon as possible. So that's the whole story of today's video. If you are a retail investor like myself and would like to know about the US economy updates and our most recent trading activities, please give us a thumb up, share this video, and consider subscribing our channel, Charlie Retail Invest. We really appreciate your time and support. You are more than welcome to leave your thoughts on the stock market and our economy in the comment section below. Thank you so much for your time, and I'll see you in the next video. Please take care.